Gold just delivered one of the cleanest institutional reactions on the chart. Liquidity was engineered above the highs. Retail traders chased the breakout and smart money instantly reversed the move. In this breakdown, we'll decode the higher time frame narrative, identify the institutional liquidity zones, and map out both high probability buy and sell setups using pure price action and smart money concepts. Starting with a 1-hour time frame, gold remains structurally bullish overall. We can clearly see higher lows continuing to form from the major demand zone near 4,550. This aggressive expansion wasn't random. Institutions accumulated positions inside the discount zone, then expanded price rapidly toward premium liquidity resting above the highs. Notice how price continuously respected bullish break of structure confirmations. Every pullback created a new higher low before continuation higher. Now pay attention to this premium zone. This is where institutions began distributing positions after engineering liquidity above weak highs. Retail traders saw breakout momentum, but smart money saw liquidity. The moment breakout buyers entered aggressively, institutions reversed the market. Equal highs create predictable stop-loss clusters. Institutions know where retail traders place stops, and price naturally seeks those pulls before reversing. The bearish displacement after the sweep is critical. Strong displacement usually signals institutional intent, not random volatility. Now underneath price we have two important institutional demand zones. The first sits near 4,680. The second major demand rests around 4,650. Current price is trapped between premium supply and nearby demand. This creates a compression environment, usually followed by an impulsive move. The market narrative is simple. Institutions accumulated at discount, expanded price upward, swept liquidity, and are now deciding whether to rebalance deeper before continuation. Short-term bearish pressure is increasing. Notice how momentum is slowing after the rejection. Buyers are no longer controlling price efficiently. Now look below current price. Sell-side liquidity is beginning to build underneath equal lows near 4,710 and 4,700. Institutions rarely move directly. They engineer emotional reactions first, then attack liquidity where retail traders become most vulnerable. Right now the market is deciding whether to continue distributing lower or revisit premium liquidity one more time before a deeper correction. Now let's move to the 15-minute time frame where institutional execution becomes much clearer. On the 15-minute chart we can clearly see internal market shifts forming after the liquidity sweep near 4,770. This change of character confirmed the first sign of internal bearish control. Momentum shifted away from buyers immediately after liquidity was taken. Notice how price entered consolidation after displacement. This is typical institutional behavior before continuation. There's still minor buy-side liquidity resting above these short-term highs. Institutions may revisit this area before another sell-off. Every bullish push is being absorbed quickly. That tells us institutions are likely unloading positions into retail buying pressure. Meanwhile, liquidity continues stacking below current lows. This creates a magnetic target for price. This is how manipulation looks in real time. Small bullish rallies attract breakout traders only to become fuel for institutional selling. Momentum is clearly slowing. Strong trends expand aggressively. Weak trends hesitate, and this hesitation signals possible distribution. Price is currently sitting inside a short-term reaction zone. This is not a confirmed buy area yet because internal structure remains fragile. Most retail traders buy after seeing momentum. Institutions buy before momentum and sell into emotional chasing. If price loses current support, the next liquidity objective sits near 4,700, followed by the deeper institutional demand around 4,680. But if buyers reclaim 4,730 with strong displacement, gold could attack buy-side liquidity again near the highs. Now let's build both high probability execution setups based entirely on liquidity and structure. The first setup is the sell scenario. Ideally, price revisits the premium supply zone between 4,728 and 4,735. We want to see a liquidity sweep above short-term highs followed by bearish rejection and displacement confirmation. The ideal sell entry sits around 4,732 after rejection confirmation on the 15-minute time frame. The stop loss should remain above 4,775 because any sustained move beyond that level invalidates the bearish narrative. First target rests near 4,700 where sell side liquidity sits. The extended target is 4,680 directly into institutional demand. Professional traders secure partial profits at first liquidity objectives, then allow runners toward deeper targets. No confirmation, no trade. Wait for sweep, rejection, bearish displacement, and structure shift before executing. Now let's discuss the bullish setup, which only becomes valid if institutions defend discount demand aggressively. The strongest institutional demand currently sits between 4,680 and 4,655. This is where smart money previously accumulated heavily. We need bullish confirmation first. That means strong rejection followed by a clean change of character on the 15-minute time frame. The ideal buy entry sits near 4,685 after confirmation appears inside demand. Stop loss should remain below 4,648 because deeper continuation lower would invalidate the bullish setup completely. The first target is the premium supply zone near 4,730. Extended upside targets sit near the weak highs around 4,770. This setup provides excellent asymmetric opportunity because risk remains controlled while liquidity objectives stay large. Retail traders react emotionally. Institutional traders react structurally. That difference changes everything. Pro tip number 1: liquidity sweeps without displacement are weak signals. Always wait for aggressive reaction candles. Pro tip number 2: institutions prefer buying at discount and distributing at premium. Context matters more than candle patterns. And pro tip number 3: the highest probability trades happen when higher time frame narrative aligns with lower time frame execution. So the entire gold narrative becomes clear. Liquidity was swept above highs, momentum slowed, and now price sits near critical reaction zones. Trade patiently. Let institutions reveal intent first, then execute with precision instead of emotion. That's how professionals survive this market. If this breakdown helped you understand institutional price action deeper, subscribe for more elite gold analysis, smart money concepts, and professional trading breakdowns.